In this video, we're not going to be telling you what we think you ought to or want to hear. We're going to be answering the sort of questions we're asked every day in our work as financial advisors, seeing clients, seeing you. And you're going to hear not just from me, but from the rest of the other members of the advice team here at Philip James Independent Financial Advice. So I'd like to welcome the two other financial advisors in our business, Louis Hammond and Kendra Seltzer. Good to have you here. And today we're going to try a slightly different format and tell you some of the things that clients have been asking us in the last couple of weeks, what we've been telling them, and why. So just very briefly, I'll ask Louis and Kendra to introduce themselves. Louis.
Hi there. Yep. So I'm Louis. I joined the firm a little over a year ago. I've spent 14 years of my career working in financial services across banking, mortgages, and wealth management. So I've really enjoyed the time I've spent here so far.
Correct answer. Thank you, Louis. And you, Kendra?
So I'm Kendra. I've been at Philip James for almost 4 years in November. Similar to Louis, I've worked for both small IFAs to large wealth managers. First entered the industry at 19, so about 12 years experience for me. And I'd say I kind of specialize in retirement planning and investment planning too.
Okay, thank you. Now, we all see clients pretty much every day of every week, and we're talking to them about their current investments they might make. So I think we all have our ears pretty close to the ground and an understanding between us all of what people are concerned about and what they're looking for from their financial advisors. So, okay, well, I'm going to start with you again, Louis. What have people been asking you about in the last couple of weeks? What are their concerns? And just pick a couple of topics and tell us something about what you've been saying to them about them.
Sure. Okay. So there's a number of things I talk about with clients all the time. One thing I have noticed cropping up is whether or not continuing to contribute into a pension with the inheritance tax changes that are coming next year. Is that still a good idea? Are pensions still as good a vehicle for investment as they once were?
Just remind us what's happening with pensions next year then, Lou.
Of course, sorry. So inheritance tax, pensions are being brought in under the inheritance tax umbrella from 2027. So previous to that, it would have been that if you passed away and you left your pension to your children or whoever, there wouldn't be a tax on that. Now or from 2027, there will be tax on that.
Inheritance tax, yeah.
Tax, yeah. So I think it's reframed pensions in people's minds because for many years they were seen as an sort of inheritance vehicle. And that's what's prompted these questions of should I still be putting money into a pension? And my answer is yes. And I think there's a few reasons why I would say that. The first thing is that they are still incredibly tax efficient. So they are one of the only types of investment where you can get full tax relief on contributions going in and still invest in pretty standard conventional type investments that are sort of lower risk. You can get income tax relief on other types of investments, but you've got to start taking a lot more risk. So this allows you to do that. There are ways that you can still pass that down to your children in an inheritance tax efficient way. We just got to be a bit more creative as advisors and think a little bit more deliberately about how we do that. And you still do get your 25% tax free when you do draw from the pension. So my answer is yes. It still is a good thing. We just need to start thinking about it differently and treat it as this is for your retirement rather than this is to give to your children.
I think, yep, I'd agree. As someone who has been doing this for an awfully long time, it's actually only 10 or 11 years since pensions became a planning vehicle for inheritance. And I think what will happen, or what the government certainly hopes will happen, is that this will take pensions back to what they're supposed to be there for, which is a way of a means of saving for your own retirement rather than saving for your children's future. And that, in theory, is why they had the tax relief built into them to encourage people to put money away for the long term. They're only going to do that, it was thought always, if there's an advantage now for doing it, which is what the tax relief was all about. Have you had similar questions, Kendra?
Yeah, I was just gonna say another point that regarding the IHT element to it, I guess it's only something to be mindful of if you think that your estate is going to be substantial. So we're looking at if you're a married couple, we're looking at, you know, £1 million threshold there until IHT is kind of an issue for you. When you take into consideration the nil rate band and the residence nil rate band, if your house passes to your descendants. So I think that's also something to be mindful of is, okay, where is my estate heading in the future? Am I going to be pushed into the 1 million? Or if I'm under that, it's not really a concern for us at this time. So adding to pensions is still a very good thing because you might not even be subject to the IHT threshold.
Okay. All right. Interesting. So, Kendra, staying with you for a moment, is there a related or another topic that you've been asked about recently?
I've been asked quite a lot recently about AI. It's a very big topic in the industry at the moment and also in every other industry. Everyone's kind of getting a bit bored of the AI bubble term. But I actually got asked the other day about how we are using AI within our business,
Okay.
which I thought was quite interesting.
Hmm.
And we obviously we go to a lot of seminars and webinars, and AI is a hot topic conversation. And I think that, well, personally, we don't use it a substantial amount within our business yet. Whether it's to come in a couple of years, we obviously take it to make our lives easier in the fact of just recording meetings or it building a transcript. But I think also people don't realize that AI has been around for a long time, not just in the last 18 months. And it's only because people are starting to worry about it because people are talking about it a lot more. I think that it will be something that will be introduced further over time. But I think clients aren't too concerned about it, but it's interesting for them to ask questions about how we are using it within our firm and how it will impact them as our clients,
I,
which is quite interesting.
I agree. I think there are probably more applications for it that we are using, which we don't realize we're using because it is actually AI underpinning it. And
Yeah.
we're on Zoom at the moment, for instance, and one of the great things which came in about a year or so ago was that Zoom will actually take a transcript of any meeting that you have, which is now something that's extended onto recordings of other meetings, and some of the back office providers that we use to help us with our business have introduced that, and that can be a great time saver. Although I'm sure most people and most of our clients out there have tried dictating notes on their phone, and just like subtitles on TV, they come up with some very interesting variations on what you actually said at times. So they still need careful editing. I think the other question I don't know about you two, but I've been asked is because there's a lot of stuff in the press about the AI bubble, and that we've had great returns from the stock markets over the last 12 months. Again, being old, I remember the dot-com bubble, which was actually 20, 25, 26 years ago now, when everything was hyped up and everything crashed. Other stuff happened after that, 9/11, Iraq War. So in everyone's mind, the dot-com bubble went on for a long time, but it wasn't actually that what caused problems. Is that something you guys have been asked about? Louis, have you had people asking about the AI rather than dot-com bubble?
Yeah, but it's often paired with just a general feeling that the stock market has never been higher. A lot of the time, clients aren't specifically focusing on it being AI that's the driver of that, but there are general concerns I do sometimes come across where people are just thinking, is this the height it's going to be? Is there going to be a correction? I suppose the answer to that would be there may well be, but we don't know when that would come. So because we measure what we do in decades rather than months, we stay invested for the long haul. And as long as we've got the investment decisions right initially, we can trust the process. It will go up, it will go down, but in the long run, you'll be better off than you would in the bank.
Yeah.
But when that moment will come, we just don't know.
Okay. How about you, Kendra?
Yeah, I was just going to say to Louis, we're building cathedrals, not casinos.
Very good. Yeah. Yeah.
But yeah, exactly that. We've had a few clients worried about the AI bubble, not wanting to be heavily invested in tech or US equities. But US has always been the main growth within the market. So I think it's getting the balancing act of not being too volatile in that region, but also having the correct exposure to it. So you get the growth, as Philip would say, you never know when it's at the top and you never know when it's at the bottom. So
that's always been true. And actually, with a lot of our investments, the investments we recommend for clients are in what are called passive funds, where they're effectively tracking the index. Interesting article I've just been reading was about the main world stock market index called the MSCI index, which is an amalgam with weightings, as they call it, so the proportions match those of how big a part the markets make up. And as you say, the US makes the biggest part of this. Comparing just investing in that index with all the various active funds, as they're called, where you've got a fund manager trying to second guess what's going to do well here, which country to be in, what type of shares to be in over the last 10 years. And the number of active funds that have actually done better than that index, which would have more than doubled your money over that period of time, actually twice doubled it. So 200%, I think, has been the growth. Very few. So it kind of reinforces the message, I think, which we have, which is, yes, my old cliche, you never know when it's at the top, you never know when it's at the bottom. Hang on in there, you'll be all right. And one thing I think you'd agree we always do when we go and see our clients is find out how much they've got that's not invested, that's in cash, premium bonds, stuff that's not going to be affected by stock markets. If they've got enough of the cash reserve, then I think we can be confident that saying, leave it in there, don't try and be greedy, don't try and second guess, because it never works. Okay, I think we've got time for one more topic. Louis, have you got anything else on your list?
Well, it's quite nerdy.
No. Okay.
Don't know if Kendra's got a
Let's
lesson.
explain. Louis is our spreadsheet king, for those who don't know him. But go on then, Lou.
Well, just some clients we have what we call a general investment account, which is essentially where we park money, we're still investing it, and we're waiting for allowances, ISA allowances, sometimes pension allowances to come around annually, where we can then move that money from the general investment account over to those more tax efficient wrappers. So I've had some questions recently about how the tax works on general investment accounts. It could be worth a very, very quick summary, just if there's people out there who are concerned about this.
Okay.
So if you want to hear it, of course.
Okay, go for it.
So the income that's generated, there's two types of income two types of tax you might pay on a general investment account. One of those is the income that's being generated by that fund. And typically that tends to be in the form of dividends. You will have to pay tax on that if it makes more than £500 a year, because everyone's allowed to make £500 tax-free a year. There may also be some interest that is earned potentially, depending on how the fund is set up. So you've got that that's going on, to be careful, not be careful, but to be mindful of. And then you've also got capital gains tax. So when you choose to sell, then you may have a tax bill that comes of having sold that. However, what we do is we try to, most of the time, only sell enough that you're not going to have a tax bill. So we do manage this, and we'll tell you if there's anything that you need to know. But you do have allowances, the capital gains tax allowance and the dividend allowance. Actually, you get those regardless of how much money you earn. So everyone has those, and we use those for our clients. So I think if you have got a general investment account, we are looking at this. We are conscious of the tax it could generate, and we do try and reduce that wherever we possibly can.
Kanji, can you just explain why we would be selling things in the general investment account for clients?
Yeah, of course. So, obviously, different clients have different attitude to risk, and they have views of whether they want to be active managed, like you said earlier, Philip, or we can use singular OIC funds, which basically means that we can manage the tax on your behalf. So, buying and selling is what causes a capital gain tax liability if the fund has made a gain, a profit. You can also realize losses. So hopefully that doesn't happen. But if the fund does go down in value, then you can realize losses too, which can offset your tax bill for that year. So that would generally be the reason why a tax liability may be raised. So that's generally what happens.
Or we could be actually selling on your behalf to move money from that account into something more tax efficient, which we try and do every year. That could be an ISA, that could be a pension. And that's when we can then try and make sure that the amount of the fund that we sell is below your tax allowance. Doesn't always work. I think we sometimes have to say to people that if you have a tax liability or capital gains tax liability, sometimes you have to think it's a nice problem to have, because it does mean your investments have gone up in value. And there are fewer and fewer places, unfortunately, to hide from a tax point of view these days. I think also the other thing I'd add, Louis, there is that even if you don't take the income out of your investment account, you're still potentially taxable on it, because people do say to us sometimes, well, I haven't had any income, so I won't have any tax to pay, will I? But unfortunately, even if it goes back in the pot, you still have some tax to pay. Okay, probably. I think that's enough for this time. I think that's been a great session. What I would say, if you're watching this and you've got any questions you'd like to ask us, send them in, and you can get to us via our website or our names, Louis, Kendra, Philip, at pjamesifa.com is the email address. Thank you for watching. Hope your eyes haven't glazed over too much, and we'll be back with something similar pretty soon.